Yeah. Good morning, good afternoon, good evening, traders. It's your guy, Nathaniel Tunde. Once again, I want to bring you a very fantastic concept this morning. I want to explain how to use Trendline in trading. I've often told my students not to rely on their Trendline, but then if they must not rely on it, what should they know in order to be able to use it and apply it appropriately? Without much talk, what is trend line? Trend line is nothing but just a straight line used to connect minimum of 2 swing points on the chart. Minimum of 2 swing points on the chart. This is swing point. This is swing point. So if you want to connect these swing points together, this becomes a trend line. It's a very valid trend line. It must be able to connect 2 swing points. Look at it based on that definition. This is swing point. This is swing point. All right. When you connect these 2 swing points together, it becomes a valid trend line. All right. The purpose of connecting these 2 points, what you want to achieve by connecting it may be different. Maybe in this case, maybe as we'll see later, maybe it's because you want to get a divergence. That is why you connected these 2 points together. You want to see whether this up move will come. You want to see whether it will come. You can test it, because when you put divergence, you see that this one is making a higher high here, a higher low here. This is a low, this is a low, but it's higher than this low. This is a higher low. But if you look at this place, what's it doing? It's making a lower low. So there's divergence. Higher low, lower low. Okay, this is what is called hidden divergence. All right. And with that, we know that this move is going to come. It's going to come. So the purpose of using the trend line may differ, but connecting 2 swing points will make you a trend line. So trend line, as good as it is, just as I said, to me, clearly is subjective in nature. Okay, as different traders can actually draw trend line on the same structure differently. All right. Different traders can come and draw trend line on the same structure differently. So people can come and place their own here. They will tell you they are considering these weeks. Okay, this is what they are considering. Some people will tell you they will draw it on the body like this and call these weeks out. They will draw it different way. Different traders will draw it different ways on the same structure, on the same pattern. That is why I always say that trend line is subjective in nature. There is no objectivity in it. All right. But what is most important is that you must be able to connect minimum of 2 swing points. Like this is a valid one. This is a swing point. 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 So the swing points you are considering must have proximity to each other. They must, be proximal enough. All right. So that is one thing I want you to know about trend line. So don't say because you have drawn trend line somewhere, so market must respect it. No. Market is not a must that market must respect it, because market is doing its own thing. You are doing your own analysis. Market is also doing its own thing. So it's not a must that where you draw your trend line, market must come there. But the essence of teaching you, how to use trend line is how to gauge area where you draw your trend line and market is likely, to come there. What other things you need to consider? What other things you need to know? All right. So since I said it is subjective in nature, then what other ideas? What other ideas, we can associate with trend line to form a complete trading system? That is what I always bring to you. Remember when I was bringing to you, divergent trading system, I was giving you some other idea, some other clue, that will help you to be able to use divergence properly. You don't get that in any place. Don't get it on any video. Giving you idea of liquidity, linking it with divergence. All right. Linking other idea like structure, linking it with what? With divergence. And it was very clear. The same thing I want to bring to you today. I want to link some other ideas that will help you to be able to validate your trend line and the possible, price level that market will come to in order to respect your trend line. Because of course, you are doing your own analysis. Market is also doing its own thing. All right. So you must combine the following ideas together with trend line in order for it to make a proper sense. Number one, you must combine trend line with Fibonacci. All right, Fibonacci. If for the sake of those that do not know what is called Fibonacci, Fibonacci is a tool that we use to measure the length of retracement of an impulse. All right, how much an impulse retraces is, the idea is given to us by Fibonacci. If you have an impulse, this is a move. When you have a move like this, an impulse, and every impulse must be corrected. When it's retracing back slowly, areas that length that it has covered before, when price is retracing it back, we call it retracement. After that retracement is done, another impulse will come. Okay, of course, we don't want to trade retracement. We want to trade impulse. All right, so we want to get how much of this retracement that the market is likely going to make. So what gives us that idea is Fibonacci. And this is a sign for Fibonacci. You see it here, Fibonacci retracement. Click it here, push it, put it here, drop it here, extend it here, drop it. It's just 2 points. Now, can you see on my measure on this schematic? Can you see exactly dropping at between 0.5 to 0.618? Experience shows that every retracement that comes to 0.5 to 0.618 is likely going to make continuation to the upside from that area. That's why there are different levels of Fibonacci, like 0.23%, 0. But I don't care about all this one. What's important for me is to get 0.5 to 0.618. Once it gets here, I know that I'm going to make a move. But what if you now draw your trend line and your trend line now corresponds to 0.5 to 0.618? Perfect. Look at it here. Let me show you an example here. Between here and here, you have a move. All right. Between here and here, you have a move this way. Forget about this pullback. It's part of this swing. Okay. This one here, you have a move here. You have connected it and it's a perfect trend line. Let's say this one has not formed. This length has not formed. It's solely this one and this one you have joined together and you have extended it. Now, if you take your fib and you take a fib from here to here, where does this end? 61.8, 0.5 to 61.8. If you take your fib, put it here and here, where does it end? 0.5 to 0.618. All right. When you take your fib, put it here, drop it here, where does it end here? 0.5 to 0.618. Can you see? So you are now validating your trend line with what? With the aid of Fibonacci. Because already you know that your trend line is subjective to your own analysis. There is no objectivity there because you drew it to just, consider, to just, to just for you to be able to consider the flow of the market. But the exact point where your trend line lies is only subject to you, the drawer. Market is not concerned about it. But what I'm now telling you is that what can you add to that trend line that is subjective in nature? What can you add it to make it fairly objective? That's what we are trying to do. So you want to add a bit of objectivity to your analysis by making use of some other techniques along with the trend line. That is all. And that's what we are discussing. So first one is Fibonacci, and you have seen how we have done it. Watch something. When you now do this one here, this swing here, excuse me, when you do this swing here, from here to here, do you see that this retracement, when it came to 61.8, what did it do? It broke it down. So when the market never gets to 61.8, like this place has not gotten there, don't even care to buy. Because you are managing your trend line with Fibonacci retracement together. Now, when it gets here, now it has gotten here. But the question is that, did it give you the price action for you to buy? No. And then how long does it stay for you to come back? It's very important. When you are seeing this thing too long here for you to come back, just know that it's developing, it's gathering order to push to the downside. So in that case, you don't even bother to consider it. To me, when I have caught a move here, I caught a move here, I caught a move here, I caught a move here, and I'm now seeing slow move, rising wedge showing here. I already know that this trend is over. That's number one. Number two, how do you know that the trend is over? This pattern that you see here is an ending pattern that you can check with the aid of what? Divergence. Can you see if you pick a trend line? We are going to see later application of trend line. If you put a trend line here, it's making a higher high. If you put your trend line here, it's making a what? A higher low. Can you see? A lower high rather. Can you see? This is a high, this high is lower, whereas this high is higher, corresponding high here is higher. So this is divergence, and it shows that this fall is imminent. So when you have seen it that way, you don't bother. You don't bother to look for buy opportunity here, because you have carried out a test here and you have seen the result that this fall is imminent. You get what we are saying now? Okay, for instance, look at here, from here to here. Can you see that it's making a higher high? And from here to here, it's making a higher high. So this tells me that I'm only looking for a retracement to my trend line for mean reversion and up to 50 to 61.8 to take a buy again, because I've already carried out a test that I'm getting a higher high here, and this one is also giving me a higher high. So which means I'm still going to get continuation. Do you understand now? So next one is liquidity. How do you use trend line with liquidity in order to validate, your trend line? We want to validate this trend line. Let's say it ends here. We want to see whether this trend line will still be valid when we extend it. We want to validate it with liquidity grab and see how it will work. Look at this. After this move down, it has not gotten there, but what do you see here? You see what? Liquidity. You see consolidation there. So after this consolidation, you want to find out whether this consolidation will break down towards the trend line or will break up. If it will break up, you don't have to prepare for the trade. But look at the way it's breaking down. It's breaking down to the trend line. And when you take a fib from here, this swing, take it from here to here, exactly at 61.8. It's exactly at 61.8, and it's coming down to the trend line, and it's breaking out of fair value here, boom, to the downside to hit towards the trend line. What does it tell you? Get ready to buy. Get ready to do what? To buy. So this is how to use liquidity grab with a trend line. You can see at this stage here, see the consolidation. Supposing this consolidation now break towards this trend line, we'll be looking for buy again. Just take your fee from here to here, get your 61.8, take it. But now, instead of it to break to the downside, it broke to the upside, and that is a sign that this trend is over. When you have consolidation, breakdown and up in an uptrend, the trend is what? The head of the trend is very sound. But when you have consolidation, break up, know that the trend is weak, because it's not breaking down to pick liquidity from demand, to proceed to the upside, but rather picking liquidity from supply. It means it's favoring sell. That is the meaning. All right. You also look at structure. one thing you also want to look at in order to determine the validity of your trend line and make it a bit objective is structure. Structure. Now, let me tell you, structure. Do you see this? You see this push? What structure is this? Regular flat. So when the regular flat is ended, when you go a little bit advanced, you will know that regular flat don't go above 50% retracement. What do you see? 50% retracement. That's regular flat for you. It doesn't extend up to 61.8 to what? To 78% retracement. It doesn't extend to that level because of what? It is a flat, it is a sideways corrective structure. Every sideways corrective structure don't make a deep correction. So when this has happened here, you know that this trend line is valid here. Let me show you another one. You have another push here. All right. Let me delete this one. Excuse me. You have another push here. Look at another push here. Okay. No, let's use this one. See another push here. Now, look at this structure. This is what is called zigzag corrective structure. Zigzag corrective structure. I'm telling you how to use structure to validate your trend line. This zigzag corrective structure is what is called a 5-3-5 corrective structure. Okay, 5-3-5 corrective structure. In Elliott wave theory, I will not go into detail here, but you have impulse, you have 3-wave corrective structure, you have impulse. This is a zigzag corrective structure. Do you see any buy candle here? No, that's an impulse. Do you see any buy candle here? No, that's an impulse. Here, you see 3-wave corrective structure, 1, 2, and 3. So this is push down, corrective structure in the middle, push down. And when you look at it, this first push down here, if you take the field, the correction is up to 50%. That's what is called a zigzag corrective structure. So when you see a zigzag corrective structure, correcting this move here up to 61.8, this validates what? Your trend line, that this trend line is valid and this market is not going to push to the downside. All right. So that's how to use structure to validate your trend line and to make it a bit objective in nature. So in that case, when you are giving this explanation and this interpretation to your trend line, somebody who does not understand this is going to knock his or her head in affirmation, because what you are doing is no longer subject to your own analysis alone. You are introducing some other theories and concepts in order to validate the trend line, and that makes your trend line more objective, more objective in nature. You are trying to remove subjectivity and you are adding, objectivity to your trend line so that it will be acceptable to all. You want something that will be acceptable to all, that the market will respect. That is the whole essence of objectivity. You want to be objective. How can you be objective if you cannot, if you cannot add, if you cannot apply some theories with your trend line, if you cannot add some concept that is widely accepted into your trend line, it cannot be objective. Do you understand now? So another thing is that session difference. The number 4 thing you must add to your trend line is session difference. In terms of what? In terms of different level of liquidity. Okay, so and it is also good in relation to your trade timing. Do you understand? You must know that when this market got to this level, assuming when this market got to this level, it has fulfilled structural requirements, it has fulfilled liquidity requirements, it has fulfilled liquidity. Okay, structural requirement in the sense that you have a zigzag corrective structure here, Fibonacci requirement in the sense that you have gotten a 61.8, 50 to 61.8 here. Liquidity requirement in the sense that you have accumulation here and you have a breakdown to grab liquidity here. Now, now, what of the session? What session are we here? The session that this market got to this level, excuse me. We want to find out whether that session is liquid or not. Remember, this is NZD USD. And in NZD-USD, it is an Asian pair. This is a pair that can move in Asia session because of, New Zealand dollar. Okay, so when this pair got to this level, this is where, this is 22, this is exactly 20200. In that is 2 plus 2 GMT. All right, plus 2 GMT. Look at it here. That is Asian session. So if you are having this Asia session with this confirmation of engulfing in Asia session, is a confirmation that this trend continuation will come. And you take your trade. Can you see that we have drawn a trend line and we have added a bit of concept and theories to it that make it objective in nature? And we are now even adding session timing. We are timing this entry on the basis of session opening. And this is fantastic, guys. So this is how I use my trend line. You get? So now, haven't understood all this. I want to now bring the application of trend line. Where do you apply trend line? How do you use it? Where do you apply it? When you need to get the flow of the market. You use trend line when you need to get the flow of the market. Like now, this market here is uptrend. When I want to get the flow of the market, I put it down here. I don't put it up here. No. No. Put it where retracement is coming back to. That is where you should put your trend line. In an uptrend, you put it this way. Let's look for a downtrend. In a downtrend, you don't put it down here. No. Because the retracement of a downtrend is coming up here. It's coming up here. And guys, this is crazy, guys. This is crazy, guys. It's coming up here. I'm giving you the real gist, guys. You don't put the trend line in a downtrend down here because you are putting that of an uptrend down. No. Because in an uptrend, the retracement is coming down. Let's look at here. Okay, here. This way. Because retracement is coming, push, retracement is coming down. So your trend line is here. Push, retracement is coming down. Your trend line is here. But in the case of downtrend, look at it. You put it here. Retracement is coming up. Push, retracement coming up. Put your trend line here. Push, retracement coming up. Your trend line here. Do you get it now? So that is how to use to apply trend line when you want to get the flow of the market, whether the market is flowing to the up, is flowing to the upside, or is flowing to the downside. You use trend line for that. Trend line also gives you idea of change of direction. When you want to get idea of change of direction, you make use of trend line. And that is where you have to make use of what? Divergence. For instance, this is a structure. It's a well-known structure, looking like a rising, channel on top of your trend. When you see something like this, just use trend line to connect the 2 or 3 points together. Use it to connect it together. Now go back to your chart, to your RSI. Go back to your RSI. Look at this swing point here. Just start from there. Corresponding point here. Start from there. Can you see that this is not making a higher high here? It's making a what? A lower high. Why this one is making a higher high? This is what is called divergence. But you see, you are connecting those points together with the aid of a what? Of a trend line. So trend line is not only connected on your price chart alone, you can also connect it on your indicator. So this is what is called divergence. And by virtue of this divergence, you know that even if this price comes back to what? To your trend line, it's not going to hold because there was already a divergence here that you have put a test and the market has not even gotten to your trend line, but you know way ahead that you are going to be looking for what? Sell opportunity. If I have to take you a little bit advanced, you see that this make a higher high, which you call a double top. Okay, but what happened to this one? This one has broken it up. That is a grab of liquidity. This is what is called equal high liquidity. It has grabbed liquidity by breaking this high to the top. Some people will be buying here. They say this is a flag. All right. You don't need to buy here. It has grabbed liquidity. And what does it do? Boom, to the downside. So if you are not knowledgeable enough to catch it from here, which is the whole number, look at it. I told you, bank take the order from whole number 0.7000. That's where the order was. If you are not able to catch it from there, look at the boom to the downside, corrective structure, that is your trade. Do you get it now? Because you already got a signal here by using your trend line to connect the 2 points or 3 points together to get a divergence. Okay, where if you don't understand this, go and watch my divergence trading strategy. It will give you an idea of the kind of pattern and structure that you can see before you apply your divergence. Okay, so you can also use it on a known structure like ending structure in order to carry out a divergence test to know of possible change in trend or continuation. That's example. This is an ending structure. You can use it. You can use your trend line to carry out a test on it. For instance, let me give you an example. If you are having a market that is making a downtrend this way, and on getting here, it's slowing down, it's slowing down, it's slowing down, slowing down, slowing down, it's slowing down. Okay, this is what is called an ending structure at the bottom of what? Of a trend. So what you do for me is that you just connect this point together. It makes a lower low, lower low, lower low, lower low. You now come to your indicator and check on the RSI to have a feel of what it's doing. You have a feel of what it's doing. You see, this is the middle line. So you can see, you can connect this line together. You see, so why this one is making a lower low here, this one is making a higher low, higher low, higher low. That means the momentum to the downside is not there again. And that means this move to the upside is not negotiable. This move will come. But can you see, with the aid of a trend line now, we are able to connect this ending structure together. And we're able to also use trend line to connect our indicator together to have a feel of whether the reversal will come by doing a divergence test. So that's where you can also apply a trend line. Also, if you are having an ending structure where you have it this way, you have up, down, up, down, up, down. At this stage now, you are not having it this way. Having it this way. So you need to connect the points, connect this point together, go to your indicator, and also go to your indicator down here, and you will see that you'll be seeing something like this, showing that this one is making a higher high, this one is making a lower high. This is called a divergence, and that gives you a signal that this move to the downside will come. Do you understand? That's another way you can apply a trend line. So it is useful for pattern like triangle to ensure it falls within the guideline of its formation. For the sake of those that may not know what is called a triangle is a 5-wave corrective structure that will label A, B, C, D, and E. Okay, you have something like this, you have an impulse this way, you now have a market resting, forming a triangle, resting, forming a triangle before it will make this move to the upside. Okay, so if you draw this, if you connect this point together, can you see? It's already making a triangle in 5 waves. Where are the 5 waves? The 5 waves are not labeled in 1, 2, 3, 4, 5 because it is not an impulse, it's a correction. So this becomes A, this is B, this is C, this is D, and this is E. So your impulse that you have here, guys, the impulse that you have here, this impulsive move here, will now continue after the E is formed. Now continue here for the continuation. So this is a triangle. So why are we applying trend line in structure like triangle? We want to ensure that this one does not come here. If this one break this trend line here and come over here, it's no longer a triangle. It must stay within the boundary of the triangle. This one must not come here. No, it must stay within the trend line. It must stay within the trend line. The only one that is exempted from this rule, that particular wave can break the trend line, is this wave E. It can do what is called an overshoot. And this overshoot is a grab of liquidity, in which case you may see consolidation here. After this consolidation, it will just break, grab liquidity from demand, and then move to the upside. This is a rich gist I'm giving you guys. A rich gist. This is called real market analysis to the core. You can't have this understanding and fail in this market, guys. So for that reason, just give me a like. Subscribe to this channel if you have not done so. Watch some other videos. Make a comment. Watch some other videos. Great content I have pulled up on this channel. Subscribe to it. Share the links for your friends to benefit. Give me a comment. Just write a comment. If you want me to do any video for you, just give me the comment there on the comment section. Just say, hi, Nat, I love your video, or I don't like your video based on your opinion, but I want you to do a video for me on Elliott wave theory, how to do wave count, how to understand corrective structure. Tell me, how do you analyze market session? How do you know what to trade? These are all important concepts that you must understand in order for you to make progress in this business. And I've got you covered, guys. I've got you covered. I can make video on anything for you as far as this market is concerned. Just hit me up on the comment section. I will gladly do for you. So always ensure that you don't use, that's my conclusion to you. Always ensure that you don't use trend line alone. Just as I told you, always ensure you don't use divergence alone. You must use it with some other theories and concepts in order to validate your opinion, in order to make your opinion fairly objective. And you know that objectivity is what is needed, to make your analysis play out. So always use your trend line with Fibonacci, always use your trend line with liquidity, always use your trend line with structure, always use your trend line with structure, with session differences in terms of liquidity. All right. So these are things you must consider in order to succeed in trading trend line. All right. I believe I've been able to get you covered as far as this concept is concerned. So I'll see you next time on another important concept. Bye for now. Peace.